All right, that was not the start to the new year that anybody really expected. That was more kind of like 2020, the kind of selling we saw today. So I'm going to break down today, whether or not that's the start of more to come, or whether or not it was just kind of a flash in the pan, and what we can expect to see for the rest of the week and for the early part of this month so far going into expiration date. There's been a lot of expectation of when are we going to? I mean, we've been so aggressively overbought for so long, extreme in a lot of different sentiment indicators. Did we break that today? That's what I want to talk about, and what it means, and then what do we do about it? And how can we take advantage of weakness that we may come? Is there any areas that are more weak than others? Obviously there is, and that's where we will take advantage. So let's go ahead and get started. Today is Monday, January the 4th, 2021. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see this big engulfing pattern, basically engulfed all of last week, most of last week, pretty much all of last week, when you consider it was a 4-day holiday week, and then a little bit of the week before, the Christmas week. So it was a pretty down week, day, excuse me. But fortunately, we did come up off the end of the day. So that actually kept the momentum line from dropping to extreme lows. It kept the near-term line from dropping. It is bouncing up, and we are kind of gradually getting lower highs on the near-term line after we diverged up during, up to that peak here early last week, and then now potentially diverging again with these highs. So kind of gradually moving higher as the near-term line gradually moves lower. The intermediate line here is still in the upper reversal zone. So we still have a strong bullish posture. The market sentiment line is almost in the reversal zone. So the long-term trend obviously is strongly bullish too. But you can see the ramifications this has. Actually, if I activate this drawing and move this now to today's high point here, you can see we pretty much got down to the 23% level on an intraday basis. Now, I've told you before that anything between 0 and 23 is noise. So as bearish as today seemed, it's still just noise, right? Not until you break the 23% are we now in an intermediate pullback mode. And you notice we didn't drop. We dropped just briefly below the 30-day moving average on an intraday basis, but didn't finish down there. The 23% line's a little bit below that. So you can see now how, why we would need to break that if we're going to really get moving on an intermediate decline. You can see this long-term market sentiment too. If I move this up to this high point, the 23% line of the market sentiment, that's kind of, we're talking about that would be kind of worst case scenario on a pullback coming down to this 33.98 level, which you can see is right in this area. Right, it's basically where the old pre-COVID high is. Kind of sitting right above that 78% retracement of the current intermediate rally that we're on right now. So I think that's kind of our worst case scenario. More likely we'd probably hit some support here at 34.40 first. Maybe hit that on an intraday basis. But then again, that's if we are indeed starting a pullback. And if I show you here, this chart here, then you can see, okay, we've kind of had a day like this before, but not too serious. We did have a bigger jump in volatility, but we had a bigger jump in volatility on this down day too. That really wasn't much of a down day. So intermediates, there's still a really wide gap that's even gotten wider now between historical and implied volatility. Usually historical volatility will follow implied up because that's what it does. And again, we didn't have very much of a gap at all. In fact, we gapped up this morning and fell in the early morning. So it's not as bad. When you look at it here, it doesn't look nearly as bad as like what started the intermediate decline in September. So that down day there, that started the intermediate decline in September. And we had all the way through to the end of October, as you can see here. So it doesn't look nearly as bad as it did then. And like I said, not even a gap. We did have a pretty wide gap going into that September move, and so we'll see if we kind of follow suit on that. But the market forecast chart here, and especially when you look at, say, like the Russell 2000, which hasn't been nearly as bearish not as bad as what we saw today on the S&P. The Nasdaq, same engulfing pattern, but the Nasdaq had been so sideways that that's kind of where a lot of our weakness was, and you can see the near-term line is steadily moving lower towards the lower half of the chart, despite the bullish posture that we continue to have on pretty much all these indexes except for the Russell. The Russell actually, after being the strongest index for so long, is actually the closest to not having to having pink shading again. Now, we had pink shading and yellow line before, and that was a really good buying opportunity for the Russell. We'll see if that ends up being the case. Probably not going to be the same case again, but we'll see. We have to expect that when we get light pink shading and or a yellow line, that ends up being a bullish signal in the short term rather than a bearish signal. It's going to all depend upon how far down below that 30-day moving average we get. If we just hit this 23% level, and we get light pink shading, the yellow line even here, and that's all we hit, then I would fully anticipate us to bounce right back up. I don't know how long it would last. Probably wouldn't look exactly the same as that last rally in the Russell. But I'd expect that we'd bounce back up. If we break that 23% level we get yellow line, light pink shading, but we're down here, then I would not expect us to pop back up, and I would expect that would lead us to dark pink shading and a red line that we're actually starting to see on a lot of individual stocks here lately. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. Quick way to give us feedback. If you don't like our videos, you don't have to click on anything. You don't even have to watch us. But if you do like our videos and you want to let us know, we really appreciate those thumbs up. That goes a long way for us, and it helps us out a lot, actually, with YouTube. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Let's keep that conversation going. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right here at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, we invite you to check out some of these things on the right, including our classes over here. We have 8 different trading rooms and 2 Q&A sessions throughout the week. We also have our Market Outlook live videos where I do live videos every day. I do the Market Outlook. We review all the old trades we've done, see how they're doing, whether we need to close them or not. Not a lot of people will continue to manage trades they talk about. They'll tell you, look at this stock, buy that stock, I like this stock, overweight, whatever, but then they don't follow up and say, how do you manage that trade? That's what we do in this video. Also come down here, click on this heart. It opens up a new tab. Click that like button there. Oh, that's a nice picture. Nice. That's kind of where I want to be right now. Also click this thumbs up icon. Opens up another new tab. And you can click the click that like button right there, the thumbs up icon. Again, the more you do that, the more people will see our content. Facebook and Twitter will promote content to all of our followers that have more engagement. So that's why we ask for it every day. Also benefits you because Twitter and Facebook will promote content from your timelines, from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, let's get back to the charts, and you can see here when I look at the long term, the weekly chart for the S&P. Remember, we've had a couple really sideways weeks, and we still have a very, very strong long-term momentum. Like the PPO is still really, really high, and this is an apples-to-apples comparison. So you can look back on a long term and see just how high it is. I mean, it is very, very high here, which measures the gap between the 50 and the 200-day moving average relative to the 200-day moving average. You also see that we're getting a little bit of a sideways candle. I mean, we've got an upper and a lower shadow already this week. So we'll see if this ends up. We had a transition 2 weeks ago, and it didn't, luckily for the, we were going to end up with another transition last week until that very end of the day, end of the year rally. But we're starting off with a transition candle so far this week. It's leading us into 2 red arrows as of right now, with a pretty decent jump in volume today. If you look at the 2-line version of the chart here of SPY, we ended up jumping back or just barely closing below the 17-day moving average. The MACD itself went back down below its moving average. It's been following it lower this whole time while we've been rising. And the stochastics, like the intermediate line, is also forming lower highs here and looks like it's trying to roll. In fact, at one point today, it was down below its moving average here. And you look at IWM. Remember, IWM was closest to an intermediate decline. Look how bearish the MACD and the stochastics are here, as we are also just barely sniffing that 17-day moving average. So we either bounce off of this right now and feel pretty good about things going into tomorrow, or if we close down and fill in the gap between the 17-day and the 30 and close below 17, there's a good chance that that negative momentum might carry us down towards some Fibonacci retracement levels. Let's take a look at the RSI and the CCI. Nothing too significant other than we're not bullish anymore. We're not above 60, but we haven't dropped below 50 or definitely 40 yet. So nothing too major there. And then when you look at the DMI for SPY, again, nothing too significant here either. We did get a relatively low negative index, but it popped back up above 20 with the positive index dropping back down below 30. So it's, you know, we were getting a pretty an increasing ADX again, so we'll see how that turns out, whether or not the ADX gets back above 25, the negative, with the positive getting back below, or whether we stay at these relatively bullish levels here. Finally, let's take a look at the Bollinger Bands for SPY, and again, we have some room to go before we get to the value area. So, you know, nothing too significant here from an intermediate pullback yet. Not until we get, you know, break these old lows over here that I mentioned to you earlier. And even then, you can see on the market sentiment decline, that's about as low as we would expect it to go, and into that 338 area. If we had any kind of pull, I mean, that's nothing. That would be, we'd fill in some gaps and we'd feel pretty good about that and be done with some gap filling. But that wouldn't be very significant of a drop at all, and would set us up for a really good rally. You know, depending upon how long it took it, and it would probably take a month or two for it to get down and mess around down in that area before popping back up again. All right, now let's take a look at an intraday chart here. And look at that craziness that we had. So we did get the 4-week high. You know, disregard that. So this is the 4-week high here at 375.45. Today's move. We did drop through the midpoint of the 4-week range. We filled in that gap from last week, that the post Christmas gap there. Filled that in. We filled in the rest of this gap here prior to Christmas, and then you can notice, you know, we pretty much have filled in all recent gaps now. But you can see too that we've really kind of tightened up 362 to 375. It's only a 13-point range. That's well below 5%. We've really tightened up the gap between these two lines, which is why we're kind of starting to get some volatility here. You know, 362 is not very far away. If I were to zoom out a little bit, you can kind of see it in context. See how we had a really good trend going, and then now we've been just really flat and sideways. That 362 area, that's, you know, if we break that low, you know, there's again not a lot of volume, and that's where the 23% retracement level is of this rally that we're on. In fact, we have to do this here. Let me activate that. Oops, sorry. Let me activate. There we go. So coming off of that low down here and moving this up to this high point where we're at now, you know, again, that 23% level is right there, right at that 362. It's a very important level of support that if we break, now we are in an intermediate pullback mode, right? And if you look at the volatility index too, to see, you know, is it telling us that we are intermediate pullback? We did jump all the way up to 100%. So we went through the neutral zone, which we had been below this whole time. We went through the neutral zone all the way up into and stayed above it this time. Last time we got up, we went through it, and by the end of the day, we were back down at the bottom end of the neutral zone and back through it the very next day. So here we rallied up through it and stayed above it this time. So, anything in this area, we're just looking at intermediate pullbacks, and that's all if we get that right now, that's all I expect at all. Otherwise, if we come back down through this retracement zone or this neutral zone, then we're not starting an intermediate pullback yet, and more than likely we're going to kind of grind back down again like we did here before getting a pop sometime later. If I take a look, I've shown you this chart before, but if you take a look at a longer term view of a weekly chart, I mean, you can see what the volatility index looks like now. That's only one day. So at some point in time, we're going to get where we finish the week with a pop in volatility, like what we're starting to see here. Whether or not this ends up being it or we look like this red candle again, there's still a pretty good chance we get another candle like that. So let's keep our eyes on and peeled as to whether we break through 30 or not. If we break through 30 tomorrow or Wednesday, then we probably will finish up with one of those strong weeks, which is not bad because you notice every time we get them, we come right back down. So it's not a bad thing. But if we come back down through to the 22 by the end of the week, then we still have one coming, right? That's what we need to kind of keep our eyes on and what we need to hedge for, especially considering, as I've shown you before, how strongly bullish we are or have been. Today's volume and trading range picked up today. So the volume ended up being 110 million shares traded, and today's range was 10 points, 10 points there. So if I look at it here, you can see about 107 points. So when I look at this, when I go back to this chart, again, 10-point range brings that ATR up higher, and we never did get below the 1% level, right? A volume 110 million also brings it up higher. So more days like today, and as you saw that here, we followed up that down day in September with more big days. More gaps to the downside, more big down moves, bigger ranges. We followed that up. Some of these other times we didn't. Like we had a little bit of a move there. We didn't really follow it up with much. We've had a move now, and we'll see if we follow up with more or if it ends up being like this. And I'm still kind of leaning towards we'll probably end up looking like this. I don't think this is the pop yet. It's probably just a little bit of a warning sign, kind of a shot across the bow, so to speak. But I don't think that we'll follow up today's move with more days like this. I think it'll kind of flatten out. We'll probably get an upward move, a green day where we're above 1% or around 1%, and then back to nothing days as we fizzle back into this gap and we keep getting small gaps here one way or the other. All right, before we start looking at some other asset classes, just to summarize the technical outlook, there's a little bit of a warning, like a move like today that's more sustained is coming. I don't think it's going to be this week. I think we'll follow up today's move with a bounce, either tomorrow or Wednesday, and then finish out the week on a relatively positive note. But whether it ends up being now or later, we do know there's going to be a pop in volatility. It's going to be one of those moves that will lead to an intermediate pullback. Where we do break that 23% retracement level, but I don't think necessarily it will be here. And when it does, it will be okay, because when it does, then we'll set up, for a good, we set the bar so high because we finished at the high of the S&P last calendar year that it's going to be hard for this calendar year to get such a high return because the bar is too high. The bar sets up for an early part of the year decline where it might take a month or two of drawdowns before we get the expected bullish move by the end of the year, which is what I'm fully expecting in our long-term portfolios. I still think we're going to have a very good bullish 2021. It just won't look the same as 2020 because while we won't have the same kind of COVID decline as we had last March, we will still have an early part of the year because we didn't have any at the end of the year. We're going to have more of an early part of the year where we do get a breather for a month or two and set us up a low point, maybe a little bit of volatility in the spring, late spring, before we really get going again, as is kind of typical. So, little shot across the bow today. I don't think it's there yet. I think today is still a little bit about nothing, but we'll see what happens. Big geopolitical risk here in the U.S. at least with the Senate runoff race, and how and when that will be decided, and the impacts that will have. I think the market will take the rest of the week trying to figure that out. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below what you think, especially if you disagree. And maybe you think, you're expecting it'll be a lot more bearish already now. Maybe you think we're not going to get a drawdown here in the early part of the year, and that this is the pullback, and we're full bore ahead now going forward. You're a lot more bullish than I am. Either way, let me know and show what you're looking at, what indicators or charts you're looking at that would suggest why you're either a lot more bullish or a lot more bearish than I am. All right, now let's break down how these different asset classes perform. Of course, we know small caps have had a really good run here off that October, that Halloween low point. In fact, they've had the best run, and so has emerging markets. But let's just look at here just today alone and see how things have started out the year. And you can see at the beginning of the day, things were okay. Emerging market stocks were up. Now, gold was up too. The dollar was relatively flat down just a smidge, and you can see real estate, but then everything dropped, and at the lows of the day, Qs were down, small cap stocks were down, S&P was down. It was pretty broad selling in the U.S. asset classes, but not internationally. Like emerging markets still stayed positive at the worst of the day. Emerging markets were still positive. The dollar was still slightly down. Bonds were up on just a smidgen. Developed markets were down, so it wasn't a complete risk-off day. The benefit, the dollar benefited some of these asset classes like gold and emerging markets and developed markets. When you take a look at like how the dollar is doing right now, and let's look at it relative to the euro, since that's its main competition, so to speak. We did finish the year with a down day. And then we're trading now inside the range of that last day. So, we're kind of setting up for some divergences. You can see the near-term line here diverging on a lot of those. You take a look at the MACD and the stochastic indicators for the Euro-US dollar. You can see they're diverging here. You take a look at some other common oscillators that show divergences, RSI. And CCI, and they're diverging. So everything is diverging, but nothing's really breaking. In fact, you could draw a pretty decently straight trend line off of this low point, that November, the Halloween low point coming up here. We haven't broken that yet. But you can see kind of that we are trading relatively close to some kind of breakdown in that. And of course, more than likely that would occur with some kind of risk-off move where asset classes, risk asset classes like equities, for example, would show some weakness, and things like bonds, which have been weak, which have been kind of basing here, would show some relative strength. Here's more of a look here. You can see we're kind of basing right around this 23% retracement level, and not really going. In fact, the MACD has been rising this whole time. The stochastics has been gradually moving higher too, as we've been kind of flattening out. So it looks like bonds is poised for a move where it jumps back up towards the top here, from 23 back up towards here. I don't know if it will get all the way up to 170 on the next intermediate decline on equities, but you can kind of see the direction that's going. If I take a look at how gold is doing, and here let's go to the market forecast, you can see it for long-term bonds there, but let's take a look at gold, and you can see the breakout. In fact, let's look at it from this perspective, the breakout that it had today. So dark green shading, green line, big breakout move. I think gold setting up for a move, again, can be a risk, and, a safe haven trade as well. I think it's kind of setting up for a similar type move that we expect to see in bonds. Now, gold's been a little different than bonds. If I go back a couple of years and you say, okay, well, off of the COVID low point. So here we are. If I can get there, there's the COVID low, and we're kind of back up to the, we made this stronger rally coming off the COVID low in gold. We pulled back down towards the 50% retracement, and now we're headed back up above the 23. So we're kind of setting up for a new bullish move. Well, if you take a look at long-term bonds, again, here's the COVID move. We didn't go up so high. There's the COVID low point. We didn't go up so high like we did in gold, but we've been kind of basing here, and like I said, setting up for its own move up towards this 171. So it appears this risk on move that we've had that started in early September and really kicked into gear after Halloween. It appears that this risk on move is kind of puttering out, and we're headed towards a risk off period, which is not surprising because we've been so bullish for so long. It wouldn't be surprising to get a risk off period. Let's take a look at crude oil. Crude oil has been pretty bullish. It did get a cluster here recently. Then you can see today's move, first day of the year, and it's a relatively down, long upper shadow. You can see the MACD, or the near-term line's been working its way lower as we've been sideways over the holidays. It looks like it's trying to get a little bit of its own move to the downside after finally kind of breaking out here after being sideways for so long. But again, we might get some light pink shading and yellow line before things kind of turn back up and get going. So all these asset classes appear poised for some weakness. Now, does that mean we're going to tank and then the weakness is going to be done over in a few days? No. More than likely, the weakness will take a month or two, and more than likely, it's not going to look like down, 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 down. It's going to look like down, up some, but not very much. Down a little bit, up a little bit, so we're sideways, and we go down a little bit more, and it will just be kind of a slow grind to the downside because there's the market is still so strongly bullish that it would take in a pretty extreme catalyst as we saw in March, a COVID, to produce that kind of pullback. More than likely, it's just going to be very similar to other periods of risk off, like May of last year, August of 2019, August 2019, before we turn back up again, where it's it was more of a grind, and we had maybe a little bit of selling at the very tail end, and then we were done. Same thing over here. All right, now let's take a look at how different sectors perform. Let's pull up the 12 grid here, and you can see, let's just go look at today alone and see how we perform today. So we'll go to the 4th, and we'll go to a 10-minute. So energy started off strong along with materials. Everything fell by the end of the day. Technology, communication services, industrials, which we'll talk about here some. Utilities and real estate were both down. Staples was down there with discretionary. In fact, Staples underperformed discretionary. And then you can see by the time we rallied, everything kind of rallied here. Healthcare a little bit more than others. Financials rallied a little bit. Technology still lagged behind the market, but industrials really lagged, and so did utilities and real estate. So again, not the most risk off when their safe haven asset class is the one that dropped the most. So take that with a big grain of salt there, and but it's also not the most bullish either when energy is your big winner, because we know how poor of a sector that is. Energy is not the sector we want to lead our next leg higher. Eventually, you're going to want technology, communication services to come back up here. But for now, if that's the kind of weakness we get, that's not bad. That's not bad weakness at all. When you look at their 12 grid here and see what they look like here, again, we are just so far up above moving averages that they pulled back, and industrials actually broke down and now has dark pink shading and a red line. It's the first one to have dark pink shading and red line. Real estate's got it too now, and utilities got light green shading and yellow line and broke down pretty hard. So those two areas are really kind of selling off pretty hard here. Everything else is still dark green shading and green line, right? Except for industrials. So let's pick on that sector for our trade idea today. So let's go to the stock I want to take a look at is CSX. Obviously CSX Corp, railroad company here. It also has its own dark pink shading and a red line, and we broke down and closed below a lot of lows here. Obviously well below its market sentiment line, well below the moving average now. You can see it's also below its 8 and 17-day moving averages, which are both below the 30 and falling. MACD is falling, stochastics is rolling back over. You take a look at like its Bollinger Bands, and you've got a gap of volume here that it's going to be really easy for it to break down through. We are down well into the lower half of the chart, well into the lower quartile of the chart here. And good opportunity to kind of fill in that gap before we get earnings coming out after the January expiration date. You take a look at its RSI and its CCI indicators, you can see how they're rolling over more bearishly than say the broader market is. You look at the DMI as well. Same thing here. We were, the most bearish that we've been in a while since this little pullback right there. This one's a little different. This one was we were upward trending. We pulled back and bounced right back up. Here we haven't been upward trending for a while, to the point where the ADX has gone really low after a very strong bullish move. It's setting up for kind of a bounce back up with a bearish one coming. So we'll kind of keep our eyes peeled for that trade. You take a look at the long-term chart, and you can see we've had multiple transition candles setting up for this rollover of the PPO from 10% down, potentially even filling in this gap between this relatively large gap between the 50 and the 200-day moving averages. So I don't want to be too aggressively bearish because the market's not aggressively bearish right now, but we can take a look and sell a bear call spread. So we'll sell the 92.5 and buy the 95. Basically, what we want it to do is stay below 92.5. We got into it with with about 70, I think it was 74 cents when we got into it. So we're up already a little bit. We did that during the Market Outlook Live video before the market closed. And again, you can see the idea here where that break even is. It's got to get back through this volume node and get back up to new highs for us to get triggered to where we'll lose. I'm trying to make 444. I'm putting up $1,000 of risk even with the earnings, but I'm only willing to lose 444. And one of the reasons why I'm willing to do that with the earnings coming up is there's a chance that we can make a pretty decent move well before we get to the earnings and make 50% of the maximum gain while still being more than 20 days out, so that we can just close the trade, take our gains, and move on. So that gap kind of opens up that possibility to be a little bit more likely, especially with us closing below all these prior lows, making something like that kind of move a lot more likely now. Okay, well, that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. You can open up any new thread there with any questions or comments you have. I'll reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon on Twitter and Facebook too, as well as comment on our videos. Have a great rest of your Monday night, everybody, and we'll see you all next time.